All right, let's dive in. Today, we're taking a deep look at the state of American free markets and whether those free market principles can still deliver economic stability, especially considering recent events that have really shaken things up, like Trump's tariff shakeups and a huge market crash. We're going to be using Thomas Philippon's book, The Great Reversal, as our guide to understand all of this. The goal here is to give you the crucial insights without getting bogged down in all the complexities.
Yeah, I think what makes Philippon's work so timely and so relevant is that he uses a lot of data to challenge a lot of these long-held assumptions and beliefs that we have about the American economy. It's really data-driven, and that allows us to take a more skeptical and informed perspective.
Yeah, he definitely emphasizes the importance of data right from the get-go. He even throws in that Sherlock Holmes quote, data, 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 I can't make bricks without clay. That really sets the stage for his whole argument.
And he even has another quote in there, "In God we trust, all others must bring data." It kind of highlights that even when we're dealing with complex ideas or even ideological beliefs, we need to ground ourselves in the facts and not just our gut feelings.
Right, right. And I love that analogy he uses about, like, if a manager tells you competition has never been tougher, you should probably take that with a grain of salt, just like when your barber tells you you need a haircut.
Yeah, exactly. Exactly. It's a reminder that everyone has their own perspective, and we need to be wary of relying too heavily on anecdotes or even just general intuition. And Philippon highlights this by discussing Robert Gordon, an economist who's actually challenged the widely held view that the current pace of technological innovation is truly revolutionary.
So, armed with data and a healthy dose of skepticism, let's jump into some of the specific examples that Philippon brings up about competition and policy in the U.S. And he points to the deregulation of airlines under President Carter and the breakup of AT&T under President Reagan as really bipartisan successes in actually increasing competition.
Yeah, and I think those are great examples of how government action, even when it comes from different sides of the political aisle, can create more competitive markets that actually benefit consumers. So, for example, airline deregulation, even though there were a lot of concerns at the time, led to lower fares and more travel options for a lot of people. And the AT&T breakup really fostered innovation in the telecom industry.
But then he throws in this curveball, right? The Telecommunications Act of 1996, that was also intended to boost competition in telecom.
Right.
But what happened? We saw a ton of mergers.
Yeah, yeah, and I think it really shows that even with the best of intentions, policy can have these unintended consequences. You try to predict how an industry is going to respond to a new law, especially with technology, and it's incredibly complex.
And this brings him to what he calls the blessing and a curse of the interaction between technology and regulation. So on the one hand, technology is always pushing regulators to adapt, which is good.
Right.
But on the other hand, it becomes much harder to understand if a policy is actually achieving its intended goal.
And what's really interesting is that this complexity actually creates an opening, right, for people who want to influence regulation for their own benefit. It becomes easier to make these arguments that sound plausible, but are really more about serving special interests than promoting real competition.
All right, let's talk about the decline of U.S. leadership in broadband. This was a really striking part of the book. So, Philippon shows that back in the year 2000, the U.S. was ranked fourth in broadband penetration among developed nations. But by 2017, we had dropped all the way down to below 15th. That's a huge drop.
It is. It is. And it raises the question, how did we, the inventors of the internet, end up with slower and more expensive broadband than so many other countries?
Yeah, it's really perplexing. Now, Philippon zooms out a bit to talk about the fundamental goals of economics, right? We've got growth, which is all about making the economic pie bigger.
Right.
And then there's inequality, which is how that pie is divided.
Yeah.
And he argues that competition plays a huge role in both of these.
Yeah, and I think it makes sense when you think about it. When you have strong competition, companies are constantly trying to innovate and become more efficient, whether it's improving their products or lowering prices. And all of this leads to more productivity and economic growth, that bigger pie we're talking about.
But then he points out this really interesting puzzle. You know, in recent years, U.S. companies have been making a lot of profits, and borrowing money has been really cheap. But they haven't been investing a lot in things like new equipment or research and development. It seems counterintuitive, right?
Yeah, you would think that with high profits and low borrowing costs, businesses would be eager to invest in future growth. But the fact that they're not doing that to the extent we might expect suggests that there might be something else at play. Maybe there isn't enough competitive pressure to really drive companies to reinvest those profits back into their businesses.
And of course, we can't ignore the issue of inequality. And Philippon touches on how income inequality in the U.S. has been increasing for the past 40 years. And initially, it was a lot more pronounced between the middle class and lower income folks, often linked to the value of a college education. But more recently, the gains have been concentrated at the very top, with the top 1% seeing their share of income grow significantly. And he notes that the wage premium for college graduates has actually kind of plateaued since 2000.
Right, and that's a significant shift. And if you think about the role of competition, it suggests that maybe a lack of competition allows these dominant firms and the individuals at the top of those firms to capture more of the rewards, contributing to that widening gap.
Okay, so to understand what might be stifling competition, we need to understand the idea of market power. And Philippa defines it as a company's ability to raise its prices and increase its profits without losing too many customers, because those customers simply don't have any good alternatives. It's what economists call low elasticity of demand.
Right, so basically, in a truly competitive market, if a company tries to hike up their prices, consumers will just go to one of their many competitors. But when a company has a lot of market power, they have a lot more freedom to raise prices because consumers don't have many other options.
He gives a simple example with airlines. Let's say the cost of operating a flight is $200. In a highly competitive market, an airline might only charge like $210, just a small profit margin. But if one airline dominates a route and there aren't many other options, they can get away with charging way more than that $210.
Right. And this ability to charge above what you'd see in a competitive market not only leads to higher profits for that company, but it also means that consumers are paying more than they should. And that can have broader implications for the entire economy.
And to show the real benefits of competition, Philippon talks about what happened in France when this new mobile phone company called Free Mobile entered the market. And the results were actually pretty amazing.
Yeah, and it was really remarkable how quickly those changes happened. Within 6 months of free mobile arriving, prices dropped to like 40%, and the quality of service actually got better. It's a clear demonstration of how more competition can directly translate into lower prices and better services for consumers.
So how do economists actually measure how competitive a market is? Philippon explains that just looking at how much of the market is controlled by a few big companies, like what we call market share, that's not the whole story. You also have to look at things like how profitable those companies are or what prices they're charging.
Right, because a market could be dominated by a few big players, but if they're all constantly competing with each other, you might still see pretty low prices and thin profit margins. You need to look at a bunch of different factors to really assess the level of competition.
And then he introduces this thing called the Herfindahl-Hirschman Index, or HI, which is basically a way to get a single number that summarizes how concentrated an industry is. And it's calculated by adding up the squares of the market shares of all the companies in that industry. And because you're squaring those shares, it gives more weight to the biggest companies.
Yeah, so the higher the HHI, generally, the more concentrated the industry, and that could be a signal of less competition. But you have to be careful when interpreting those HHI numbers, especially when you're looking at a national level, because there could be a lot of competition happening at a local or regional level that isn't captured by that national figure.
Now let's talk about online retail. Philippon uses Amazon and Walmart as key examples. And he points out that while online retailers like Amazon often have lower sticker prices, you might be missing out on some things, like the expertise of staff in a physical store.
Right. Might save some money on the item itself when you buy online, but you don't have that option to see the product in person, ask questions, or get advice from someone who really knows the products.
He also argues that if you factor in the convenience of online shopping, Amazon has likely contributed to lower overall prices. But he does suggest that those benefits might not be evenly distributed, with wealthier people in more densely populated areas potentially gaining more simply because they value their time more highly.
It's really interesting to see how e-commerce has shifted our perception of value and convenience. And the data that Philippon presents shows that e-commerce has had a big impact on consumption, but it also raises important questions about how those benefits are spread across different parts of society.
And speaking of prices, it's really important to keep in mind how difficult it is to measure them accurately over time. And Philippon goes into detail about the challenges of creating price indexes, like the CPI, the Consumer Price Index, because the quality of goods changes, new products are introduced, old products disappear, and it's all very messy.
Yeah, it's a complex problem. How do you compare the price of a basic cell phone from 20 years ago to a smartphone today when they have completely different capabilities. Just a
Ah.
simple price comparison doesn't really capture the full story.
Right. He mentions this thing called the Boskin Commission, which found that back in 1996, the U.S. CPI might have been overestimating inflation by around 1 percentage point because of all these measurement issues.
Yeah, and Philippon points out that the CPI has often been slow to incorporate entirely new categories of goods, like cars in the early days or smartphones more recently. And that can also lead to overestimations of inflation.
And then there's the whole question of how you measure the value of these
Yeah.
free digital goods and services that we get from places like Google and Facebook, right?
Right.
We don't pay money for them directly, but they definitely provide some value.
Absolutely. And that's actually a really active area of research in economics. And while most economists agree that we probably are missing some of that value in our traditional economic measures, it's unlikely to fully explain the slowdown in overall productivity growth that we've seen.
Okay, so we've talked about how to measure competition and the challenges of measuring prices. Now let's look at the trends in the U.S. And Philippon states very clearly that when you look at both the market share of the biggest companies and that HHI we talked about, you see this trend of increasing concentration in most industries.
Yeah, and he cites a lot of research that backs this up using different data sources, and it all pretty consistently points to this pattern of rising concentration across a wide range of sectors.
And he highlights work by himself and other economists like Covarrubias and Gutierrez, as well as Grelon, Larkin, and Michael Henley, who found that not only is concentration increasing, but profit margins are also increasing in those more concentrated industries.
Which you would kind of expect, right? If companies have more market power, they can charge higher prices and earn bigger profits.
But, to be fair, Philippon also presents some alternative explanations for this rise in concentration, and it's important to consider those. One of those is what he calls the much ado about nothing hypothesis.
Yeah, the idea is that maybe those concentration measures are just noise, that they don't really reflect any meaningful change in how competitive the markets are.
Right, and then there's the rise of superstar firms hypothesis.
Right.
And that's the idea that, well, maybe concentration is increasing because the most efficient, innovative companies are just becoming dominant,
Mm.
and that's actually a good thing because it leads to higher productivity and potentially even lower prices for consumers in the long run.
Right. The idea being that those firms are winning because they're simply offering better products or services, not because competition has weakened.
But Philippon himself leans more towards what he calls the decreasing domestic competition hypothesis. And this is the idea that it's actually become harder for new businesses to enter the market and challenge the established players.
Right. And that would give incumbents more market power and reduce overall competition.
Right. And that would obviously have some negative implications for consumers and the economy as a whole. And then there's the globalization hypothesis, which acknowledges that increased competition from foreign companies can also affect things.
Right. So globalization could increase competition by introducing new players into the market, but it could also lead to consolidation as companies merge to become more competitive on a global scale.
Okay, now let's shift to what's happening with profits, investment, and how companies are using their earnings. And Philippon shows that after-tax profits for U.S. companies have really grown significantly as a share of the economy since the late 1990s.
Yeah, and that increase in corporate profitability suggests that companies are taking a larger piece of the economic pie than they were before.
And he presents data that shows U.S. companies are increasingly returning money to their shareholders through dividends, and even more so through share buybacks.
Right, and that buyback trend is interesting because it suggests that maybe companies are prioritizing short-term gains for investors over making those long-term investments that would support future growth.
And this connects to his next point, which is that the ratio of net fixed capital formation to net operating surplus has been declining. Basically, that means that companies are reinvesting a smaller portion of their profits back into things like new equipment, factories, and R&D.
And that's concerning because investment is what drives long-term economic growth, productivity, and wages.
Right, so to understand this further, Philippon brings in this concept called Tobin's Q. It's essentially the market value of a company compared to the cost of replacing its assets. And the idea is that if that Q value is really high, it should be a signal to invest more.
Right. So if companies are highly valued relative to their asset costs, you would expect them to invest more to take advantage of those high returns. But the data shows something different.
Yeah, figure 4.3 in the book shows this growing gap between Tobin's Q and actual investment, which supports the argument that competition is weakening. If markets were highly competitive, you wouldn't see that persistent high Q alongside low investment.
Right, and this also contradicts the idea of the superstar firms hypothesis, which
Mhm.
would predict that those very successful companies would be investing heavily to maintain their dominance.
And figure 4.4 in the book shows a negative relationship between concentration and investment. So more concentrated industries are actually investing less, which doesn't make sense if those concentrated industries are full of efficient superstar firms.
It really suggests that something else is at play, something that's preventing those companies from investing even though they have the resources to do so.
Now let's talk about how new businesses are being created and how many are closing down. And Philippon presents data showing that what economists call business dynamism has been declining in the U.S.
Right. So both the rate of new businesses being started and the rate of existing businesses failing have been going down, which could point to a more stagnant and less competitive economy.
And he highlights that this decline has been particularly strong for new businesses. The U.S. economy seems to be aging, with fewer young companies, those less than 5 years old, around today compared to the past.
Right. And that's worrying because young firms are often a big source of innovation and job growth.
Now, mergers are another factor affecting competition. And Philippon explains that whether a merger is good or bad for the economy depends on a few things.
Right. On the one hand, a merged company might be able to increase efficiency, lower costs, and even lower prices for consumers. But on the other hand, they might also gain more market power, raise prices, and hurt consumers.
Okay, so to test some of these ideas about what's happening in the U.S., Philippon compares the U.S. to Europe. He argues that because their economies are similar, the differences in their trends can help us understand what might be driving the changes in America.
Right. If these trends were solely driven by global forces like technology, you would expect to see similar patterns in both regions. But that's not actually what the data shows.
Right. He points to figure 6.2, which shows that profit margins in the U.S. have been increasing after the year 2000, while in Europe they've remained relatively stable or even declined.
Right. And figure 6.3 shows that concentration has been rising in the US, while in the European Union it's been pretty flat or even slightly decreasing.
So different patterns.
Mhm.
And Table 6.1 shows that operating margins and profit rates have generally increased in the U.S., but they've been stable or declining in the EU between the late 1990s and the mid-2010s.
Right. So taken together, these comparisons really suggest that the decline in competition might be a US specific issue rather than a global trend.
Now, Philippon also looks at how prices compare between the U.S. and Europe, and he talks about the law of one price, which basically says that identical goods should sell for roughly the same price in different countries once you account for exchange rates and transportation costs. But he emphasizes that you have to use purchasing power parity exchange rates when comparing living standards.
Right, because those PPP exchange rates take into account the differences in the cost of living across countries, which standard exchange rates don't always capture.
And Figure 7.1 shows that when you adjust for these purchasing power differences, prices in the U.S. have actually increased faster than in Europe over the past 18 years, about 15% more.
Right, so it suggests that American consumers are indeed facing higher prices.
And Philippon links this back to markups, which is the difference between the price a company charges and its cost of production. So higher prices relative to costs imply higher markups.
And higher markups can be a sign of greater market power.
Right, and Figure 7.2 compares markup trends in Europe versus the U.S., and there seems to be a correlation there. As concentration has gone up in the U.S., so have markups compared to Europe.
And Philippon's research, using more sophisticated statistical analysis, supports that link between higher concentration and higher markups.
So this begs the question, why might Europe be experiencing different trends? And Philippon points to the EU's history, founded after World War II, with a strong emphasis on promoting competition and preventing companies from becoming too dominant.
Right, and that led to the creation of strong institutions focused on competition policy, which have taken a more active role in antitrust enforcement and merger control than we've seen in the US.
Right, he highlights the EU's blocking of the GE-Honeywell merger, which was approved in the U.S., and then the case against Google, which was dismissed by U.S. authorities.
And then there was the Siemens-Alstom merger, blocked by the EU despite political pressure from Germany and France.
Yeah, that really highlights the EU's commitment to competition. And this brings us to the role of lobbying and campaign finance in the U.S. Philippon argues that the amount of money spent on lobbying and political contributions in the U.S. probably contributes to weaker antitrust enforcement.
Right. Figure 9.1 in the book shows that lobbying expenditures in the US are more than double what you see in Europe. And a lot of that lobbying in the US comes from businesses, lawyers, and lobbyists.
And he talks about research that shows that lobbying is super common, and the amount spent on it dwarfs what's spent on direct campaign contributions. And Table 9.1 shows that lobbying and campaign finance are really concentrated among the biggest firms, suggesting that those firms have a lot of influence in the political system.
Right. And the example of Sheldon Adelson and his lobbying efforts on online gambling really shows how targeted lobbying can influence policy decisions.
And he contrasts the U.S. system of relying on private donations for campaigns with the situation in Europe, where those laws are often a lot stricter and corporate contributions might even be banned.
Right. That difference in how campaigns are financed could really affect how politicians respond to the concerns of different groups.
Right. Philippon also talks about the whole dialing for dollars culture in U.S. politics. Figure 10.1 shows just how much money candidates have to spend on average in U.S. elections. It highlighted the constant pressure they face to raise funds.
And that pressure can make them more receptive to the interests of those who are contributing to their campaigns.
He gives a little history of campaign finance laws in the U.S., starting with Theodore Roosevelt, the rise of PACs, and then more recently, the emergence of super PACs after the speechnow.org v. FEC court case.
So, the evolution of these laws has created a system where money undeniably plays a significant role in U.S. politics, even if the direct impact of spending on elections is still debated.
Right. He also mentions the problem of dark money, where the sources of funding for some political groups aren't disclosed, and the revolving door where people move between government and the industries they regulate. And while this also happens in Europe, it seems to be less common in their competition authorities.
Right, and that reinforces the idea that European competition authorities might be more independent from industry influence.
Now let's focus on finance. Philippon argues that despite all the technological progress, the cost of financial services in the U.S. has actually gone up over time.
Right, figure 11.2 shows that pretty clearly. You would expect technology to make things cheaper, but in finance it seems to have gone the other way.
Yeah. And he points out that unlike most industries where deregulation leads to lower wages and prices, in finance, they tend to go up after deregulation. He suggests that the prevalence of zero-sum games in finance, the complexity of the regulations, and the market power of some firms might be factors in this.
Right, the financial sector is definitely unique in a lot of ways.
He talks about the growth of asset management and household credit as key drivers of the expansion of the financial sector. And he uses the example of money market funds and the 2008 crisis to highlight the risks involved. He also talks about the influence of investment advisor lobbying.
Yeah, the 2008 crisis really exposed the fragility of the financial system and how powerful lobbying can make it difficult to implement strong regulations.
And in contrast, he points out that in the EU, banking regulation has actually become stricter and bank lobbying has become less influential. He also talks about the increasing concentration in asset management with the rise of index funds and ETFs.
So again, we see different trends in the US and Europe.
Let's move on to healthcare. Figure 12.1 in the book shows a growing gap in life expectancy between the U.S. and other developed countries. And this is despite the U.S. spending way more on healthcare, almost 20% of its GDP.
Yeah, it's pretty shocking that the US spends so much more but has worse outcomes in many areas.
And Philippon explains that this high cost is mainly driven by higher prices for medical services and drugs, not because Americans are using more healthcare. He points out the low productivity of the U.S. healthcare system in terms of health outcomes per dollar spent. He mentions things like anti-competitive practices in the industry and how incentives and regulatory capture might have played a role in the opioid epidemic.
It's clear that the US healthcare system has a lot of problems, and the lack of competition in some areas is definitely a contributing factor.
Okay, last but not least, let's talk about the big tech companies, the GA, Google, Amazon, Facebook, Apple, and Microsoft. Philippon gives a brief overview of how they make money, and he points out in Table 13.1 that having a few dominant companies in the U.S. economy isn't really a new thing.
Right. Throughout history, there have always been these big companies that have controlled significant portions of the market.
He notes that these GFAM companies have high profit margins, but so did many dominant firms in the past. The difference now is that the GFAM companies tend to have lower tax rates, which means even higher profits after taxes. He also talks about their footprint in the economy and how, besides Amazon, they actually employ relatively few people compared to those giant industrial firms of the past.
Right. So the business models of these tech giants, with their reliance on data and network effects, lead to this natural tendency towards concentration.
In Chapter 14, Philippon looks at how much the GFAM companies are spending on lobbying, and it's been increasing, especially as they face more regulatory scrutiny.
Right, and this is something we see often. As companies grow bigger and more powerful, they tend to spend more on lobbying to try to shape regulations in their favor.
He also talks about how companies avoid taxes by shifting profits to tax havens, which is a huge problem.
Yeah, that's costing the U.S. government billions in lost revenue every year.
Now, when it comes to competition in the digital economy specifically, Philippon talks about how the nature of digital platforms, with low marginal costs, network effects, and data as a key input, all contribute to greater concentration. He discusses the risks of price discrimination, how most favored nation clauses can actually hurt consumers, and he compares the U.S. response to data privacy issues to the EU's GDPR.
Right. The digital economy presents some unique challenges for competition policy, and the EU's GDPR is a good example of a different approach to regulating data privacy.
To deal with the dominance of these tech giants, Philippon suggests a few things: limiting their acquisitions, limiting how they use their market power, and even breaking them up.
Yeah, he argues that at the very least, we should stop them from buying up potential competitors.
Right. He also proposes some ideas to make it easier for people to switch between platforms and to give them more control over their data, like opting out of tracking.
And he points out that increasing competition itself can actually be good for privacy.
He also briefly touches on the issue of labor market competition, noting the decline in labor's share of income, the use of non-compete clauses, and the decline in worker mobility.
Right, so competition isn't just about products and services. It affects how labor markets work, too.
So, wrapping things up, Philippon emphasizes the strong evidence that competition is good for the economy. It lowers prices, raises wages, increases investment, and drives innovation. And he points out that there's really no evidence to support the idea that protecting big companies leads to better outcomes.
Right, the whole protect the incumbents argument just doesn't hold up when you look at the data.
He also reflects on how economists and policymakers interact, and how sometimes the advice from economists isn't always helpful or timely.
Yeah, it's a reminder that economists don't have all the answers and that we need to be humble about what we know and what we don't know.
And finally, to really drive home the point, Philippon tries to quantify the cost of this decline in competition. By modeling what the economy might look like if competition had stayed at the levels of the late 1990s, he finds that the losses could be really substantial. He estimates a 3% decrease in GDP, a 5% decrease in consumption, and a 7% decrease in labor income.
And even though those are just estimates, they really highlight how much we stand to gain by restoring competition.
Yeah. He ends on a positive note, though, reminding us that the U.S. has a history of overcoming big challenges and that he's optimistic about the future.
Right, we've faced tough problems before, and we've always found a way to come out stronger.
So that was our deep dive into Thomas Philippon's The Great Reversal. We hope you found it helpful.
And we encourage you to really think about the evidence presented and the different arguments about what's happening in the U.S. economy.
And here's a final question for you. What's one policy change that you think would have the biggest impact on making the U.S. economy more competitive?
And why do you think that change would be effective? Share your thoughts, and let's continue this important conversation